Good morning on this bright and crisp fall day. I'm Jason Brown, the Director of Advisor Success here at Foster Group, and I want to welcome you to our webinar today. I'm joined by two of my colleagues, Stacy Newsom-Dorfer, who's in our Omaha office, and Ashley Viriger, who's in our West Des Moines office. Both of them are senior lead advisors here at Foster Group, and they also happen to have their JVs. Before we get started today, I just want to let you know that this webinar fits almost perfectly with our mission statement here at Foster Group, which is to help our clients lead lives of meaning and generosity. Hopefully today you'll learn a little something about tools, techniques, and strategies for charitable giving. The webinar is scheduled to last for 30 minutes. There's a pre-recorded portion followed by a live Q&A. If you've got any questions at all during the webinar, please go ahead and hit the button at the bottom of the screen and submit those. We'll do our best to get to them during the time, but if we don't, we'll make sure to email you our answers. And we're also, this webinar is being recorded, so if you want to watch it again, we'll be sending you a link to it in a few days following up. So with that, we're going to get started. Well, we get to talk about giving today, and we're going to spend the bulk of our time on those two bullet points in the middle of the agenda. But before we get to those, Stacy, you wanted to briefly mention something that was part of the COVID Relief Act that we need to consider.
Thanks, Jason. Essentially, when the COVID Relief Act was passed, there were two sort of new opportunities for giving that will expire at the end of this year. So I want to make sure it's on everyone's radar. And these are things that can be used by any tax filer. The first one is if you are a filer who utilizes the standard deduction, you may give up to $300 in cash to a public charity, and it will result in an above-the-line deduction. An above-the-line deduction is not typically how charitable donations are treated on your tax return. So this is a good opportunity. It reduces your taxable income, thus reducing the taxes you may have to pay. If you are a joint filer, essentially this means you can give up to $600. As I mentioned, it does have to be in cash to charity or charities. It cannot be appreciated securities. The other thing, I guess, that I should probably mention is if you give, say, $50 to charity, you can't deduct $300. You can only deduct the amount you give up to $300 per person. The other opportunity is if you're an itemized filer. This year, you have the opportunity to essentially make a gift to charity that can potentially offset 100% of your adjusted gross income. So for example, if you have adjusted gross income of $50,000 and you made a $50,000 charitable gift, that would be an offset. So for people who are really looking to reduce or potentially eliminate their taxes and have the ability to make a sizable gift, this is something you may want to visit with your tax preparer about. And again, this has to be in cash. It cannot be made through a donor advised fund. It has to be essentially you writing a check to a charity or charities of your choice. And these two opportunities will expire on December 31st of this year.
So if we have the chance, make sure to take advantage of these by the end of the year.
Absolutely.
Okay. Now we're going to talk about the donor advised fund first. That's something that we love to help people do here at Foster Group. And Ashley, remind us again of what it is and kind of the mechanics of a donor advised fund.
I'd be happy to, Jason. A donor advised fund is a great tool, and I like to think about it as a charitable checkbook for giving. You make contributions to the donor advised fund, and you can fund it in a lot of different ways, with cash, with appreciated stock. You can even fund it with collectibles or fine art. You're getting that deduction in the year that you make the gift, so you can front load it, take advantage of a high income tax year. And then the best part is that you have the ability to dole those gifts out to the charities of your choosing on your timeline. So you might say, I'm in a big tax year. I'm going to put $50,000 in my donor advised fund, but then I'm going to give it out $10,000 a year for the next 5 years. You really get to have your cake and eat it too with this kind of giving strategy. And even better, I guess this is the icing on the cake, is that they are so easy to set up and to maintain. Certainly, if you're a foster group client, your advisor can help you with one of these, but it really is the perfect blend of both tax benefits and flexibility with making your gifts.
I pretty much, it's a rule for me, Ashley, that if I'm eating cake, it has to, well, first of all, I like it if I make it and eat it, right? I get to have my cake and eat it too. And I think I love the icing better than I love the cake. So with this, I get both.
Getting that icing to cake ratio correct is really important. There's no question.
And what are some of the things, going on in our life that should cause us to think, hey, it's time to consider a donor advised fund?
Great question. Well, bells should be going off in your mind if two things are happening. One would be if you have a high income tax year for any reason. And the second one would be if you are an itemized filer. So what would that look like if you had a high income year? Maybe you're a business owner who sold a company this year. Perhaps you have rebalanced your portfolio so you have some capital gains. If you are an executive and you've exercised some stock options this year, potentially you have an IRA and you're taking the RMD from it. These are all examples of those kinds of situations where using a donor advised fund makes a lot of sense. An anomalously high income tax year, that's a great donor advised fund opportunity.
I know you did just a little bit of work too on kind of making this real for us on the next slide.
Yes, that's right. So we're going to show you today how bunching can work with a donor advised fund. And I referenced this a little bit ago, but consider the example of a married couple, and they are giving $20,000 a year to the charities of their choosing. So if they were to do that year in and year out, they'd probably be using the standard deduction, because for a married couple, the standard deduction is $24,800. So because their giving of $20,000 falls below that threshold, it's more beneficial for them to use the standard deduction. So that would be if they just gave $20,000 per year normal directly to the charity. Contrast that with if they were to bunch 2 years of their giving together to a donor advised fund. So that would be a $40,000 gift in the first year. They would be using the itemized deduction in that year because the $40,000 gift to the donor advised fund is greater than the $24,800 standard deduction. So then let's say the next year they hold off and they don't make any additional contributions to that donor advised fund. The result of bunching those 2 years of giving into 1 year means that they're going to be able to deduct over that 2-year period over $15,000 more in deductions. And if they're in the 24% tax bracket, that amounts to a savings of over $3,600. There could be state benefits on top of that, depending on where they live, but that's a very powerful savings. Best yet, with that donor advised fund, the charity is getting those gifts on however the donors want to schedule them.
Right.
So they can continue with their normal giving of $20 per year to the charity of their choice, but they're using that bunching. It results in a meaningful savings. In this example, almost $36 or a little more than $3,600.
Well, Ashley, I'm curious because you've been a financial advisor for a long time. So do you have any thoughts on how we might want to use that extra $3,600?
Well, if you're looking to get on Santa's nice list, you could turn around and donate that $3,600 to another charity, pay it forward, keep it going. You could retire debt if you have any outstanding obligations that have a high interest rate. So that's the typical financial advisor answer. Or if you're like me, maybe you'll just order an extra turkey for the Thanksgiving table so that you can have more friends and family over to celebrate.
Well, that sounds good. Are you a good cook? Because maybe you could invite me over then.
There's always room for you at our table, Jason. And I can't possibly comment on the good cooking.
Okay.
I'll plead the fifth on that one.
All right. Now, Stacy, talk to us a little bit about the qualified charitable distribution, what it is and how it works.
So a qualified charitable distribution is a great way to avoid recognizing income when you have to take a distribution from your IRA. And essentially what you are doing is diverting a partial or all of the distribution you take from your IRA to a charity or charities. So a QCD does not count as towards your taxable income, but it will count towards your annual required minimum distribution. So you can essentially satisfy your RMD each year by redirecting your required amount to a charity or charities that you favor. However, there is a maximum amount that you can give annually, and that is $100,000 per person. So if you're a couple, you can give, and you both have IRAs, you can give up to $200,000 per year to a charitable organization. Again, the check must be payable to the charity. So it cannot come to you first and then you write a check to charity. If it comes to you, you have the income recognition. So you would have to let your advisor know, I want to make a gift to XYZ charity. The check will be issued. Now you can potentially present it to the charity yourself, but you can't have the check essentially payable to you first. And this is a really nice strategy. It works not only for traditional IRAs, but it works for inherited IRAs, SEP IRAs, and simple IRAs. It would also work for a Roth. However, when you're trying to get the most tax bang for your buck, essentially, you wouldn't want to give from your Roth because distributions from a Roth are tax-free distributions anyway. So if we're trying to avoid the recognition of income, we would not be looking at utilizing a Roth for this purpose.
And help us think too, what are some of the situations in which a QCD really makes sense?
So first and foremost, for those individuals who have a required minimum distribution requirement, typically from an IRA or an inherited IRA. So for a lot of people, that means you're 72 and older. Some folks maybe have already been swept in before the change in the Secure Act that moved that needle up from 70 and a half to start your required minimum distributions up to 72. But if you have an inherited IRA, you could be any age. So it applies to anyone who has to take that RMD each year. Also really good if you're looking for a way to reduce your taxable income while satisfying that annual requirement. Why, among the many reasons, why would you want to reduce your taxable income? One, if the goal is to pay less taxes, then you want to reduce your recognizable income.
Right.
But it will also, for those who are over 65 and have Medicare premiums, it could also potentially reduce the amount you pay for Medicare. So the tax brackets, when you jump from one tax bracket to the next, tend to be a little bit larger than the Medicare premium sort of stair steps. And so lots of folks, when you have a good year and your investments have done well, you may find when you file your taxes that you are now facing an increase in your Medicare premium. So by not recognizing the income from your IRA, you can potentially avoid that increase in Medicare premiums as well. We most often see QCDs used by folks who are utilizing the standard deduction on their taxes. Now, that doesn't mean that you can't use a QCD and be an itemized filer. It's just that for most people, because the standard deduction amounts have been increased, it really wiped out a lot of the folks who itemize. But you can use this strategy if you're an itemizer as well. And then finally, even though most people who are taking those RMDs are over 72, so to speak, you can actually start QCDs at age 70 and a half. So for some folks, if they have very large IRAs, they may want to, again, try to reduce the income that they're going to recognize when they have to start taking those required minimum distributions, which now start at age 72 because of the changes according to the Secure Act. So if you're looking to reduce the value of your IRA and in theory, reduce the amount you have to take when the time comes, you can make gifts from your IRA at age 70 and a half to a charitable organization.
So I made myself a mental note. For those of us who are looking to pay more tax, this is a bad strategy.
In essence, yes. In that case, just, take as much as you want from your IRA. It's a free for all. Taxes, be darned. So yeah. But if you're looking to avoid paying a lot of taxes, this is a great strategy to utilize.
And I know you did some work too on a specific sort of case study to see this strategy at work.
That's right, JB. I think examples are really powerful. So in this case, we have Sally Wilson, and she is 73 years old, and she has a traditional IRA and is required to take a distribution each year. Her IRA balance for this year was $1 million, and that would equate to her having to take $40,486 in 2021. In a typical year, she gives about $15,000 away to her favorite charities, and she typically utilizes the standard deduction on her taxes. So in this instance, Sally could make a QCD of $15,000, and it would reduce her taxable income by $15,000. Now, she would still have to take the balance of that IRA distribution, roughly $25,000, but she again has avoided recognition of $15,000. It would satisfy part of that RMD requirement. If she wanted to, she could give the entire amount of her RMD to charity, but she does not have to. It would check the box on her desired charitable giving for the year. And as noted in the last bullet point, she can always give more. So even though she is only required to take that $40,486, if she wanted to, she could give up to $100,000 in any given year.
This is making me think. When I first started here at Foster Group, I had no idea what a donor advised fund was. I had no idea what this qualified charitable distribution is. And honestly, when I heard about both of them, there are, how should you say it? It seems like most of the time we're noticing what's wrong with the tax code and what's wrong with the government. But when I heard about these things, I thought, wow, this is fantastic. I can't believe that we encourage this type of stuff in our country. It made me feel really good. So I just was thinking about that when I joined Foster Group 5 years ago, and people started, and then honestly, we basically had to process all those qualified charitable distributions, right? And seeing what some of those people were giving, it was just really cool. So I still work with a few clients who send in their QCD at the end of every year, and it's fun to think about kind of a win-win, so to speak, for the charity and for them.
It is.
There are a few more strategies, Ashley, that you wanted to remind us of as well. These aren't the only two.
That's right. So if our charitable gathering is like a Thanksgiving dinner table, certainly the donor advised fund and the qualified charitable distribution are always at the table, but there's room for a few more at our gathering.
You need to complement your turkey with stuffing.
That's right.
And yeah.
These are our delicious sides, our green bean casserole and our mashed potatoes and gravy, you bet.
That's good.
A few additions. These are great ones to take advantage of too. First one is a gift of an appreciated asset to charity. You might be using this one if you don't already have a donor advised fund. You might want to consider a donor advised fund instead of this one, but if for whatever reason you didn't already have a donor advised fund set up, you could make a gift of an appreciated asset directly to that charity of your choice. It could be cash, it could be stock that's gone up in value, it could be a fine art or a collectible. Keep in mind though that charities like to receive cash because most of them aren't experts in liquidating stocks or bonds or a painting or a stamp collection. So we want to make sure that we're making it easy on the charity to receive our gift. So cash might be a better choice from a donor advised fund. But you could use this strategy if you happen to have some low basis stock, for example. The next two strategies are more of an advanced flavor. So these are useful if you have a federal taxable estate today. So for an individual, that would be someone with more than $11.7 million of wealth. And then for a married couple, that doubles to $23.4 million. they're really kind of opposites of one another. So with a charitable remainder trust, that enables the giver to receive an income stream during their life. And then charity receives the remaining assets at that person's passing. And then on the flip side, the charitable lead trust is a way to get charity some income while that giver is still alive and able to see the impact that those gifts are making. And then the remainder would go to heirs at that person's passing. These are great strategies that can help reduce the value of a taxable estate. So that's why they're great for those folks that are facing that kind of situation today. You'll want to talk to your tax advisor, certainly your estate planning attorney, and your foster group advisor, because again, these are only going to be appropriate for more advanced and more complex charitable giving and wealth situations. But we couldn't not include them at the table because they just play such an important role for that subset of folks that we serve.
Yeah, and I suppose something for us to aspire to, Ashley.
There you go.
Yeah. And finally, Stacy, you just kind of wanted to remind us of how we should order charitable giving in our estate plans.
Thanks, Jason. So, first I want to say a gift is a gift and it's a wonderful thing to receive. But there is sort of a hierarchy of gifts that you might want to receive as an individual. And this is really, again, from sort of a tax perspective. So what might you want to consider giving to charity, say, rather than your children? The first thing would be your traditional IRA or any other type of retirement account that holds income that has not been taxed. So your Roth would not fall into this, but any other type of retirement account with pre-tax dollars would qualify. An annuity is another thing that would be better left to charity than your children. I have encountered numerous people along the way who didn't seek advice when they inherited an annuity and were very unhappy when they filed their taxes. They discovered that they had a very large tax bill. And the reason being is with an annuity, you put in a sum of money and it grows tax deferred. But when you take the money out, you get a return of the money you essentially invested, as well as the growth on that money. And the growth is taxed at ordinary income rates. It is not taxed at a capital gain rate. So that can lead to a very unpleasant surprise because oftentimes annuities are in place for many years. And so it wouldn't be unusual to say have an annuity that had a $25,000 basis with say, $150,000 of embedded gain if it had been invested for many years. So that is a very unpleasant surprise when filing your taxes. So that is an asset that is better left to a charitable organization. And that essentially encompasses the next bullet point, any asset that is going to result in a large income tax consequence. So the takeaway is if you inherit something, if you inherit anything, it's probably best to visit with your financial advisor or your tax advisor, maybe before making any moves with those dollars or the asset you receive. And then finally, unique assets. So let's say you have a really large taxidermy collection. You were a big game hunter. You've got the water buffalo on your wall and the 12-foot grizzly in your den. And while the 12-foot grizzly is kind of fun and you could decorate him for Christmas, with a hat and things, and your grandkids might think the grizzly is great, your daughter may not appreciate the grizzly. So, Ashley mentioned that sometimes it's hard for charities to dispose of a unique asset, particularly if it's a smaller charitable organization. It's even harder for an individual to figure out how to sell a taxidermy collection. That's kind of a unique, specialized market of people who want that. So that would be something that would be best left, say, to like a Smithsonian or a sort of a natural living museum. What was that, Jason?
Cabela's, for instance.
Sure, exactly.
Yeah.
So, giving it to charity, the key here is giving it to a charity that it ties into their mission or their purpose. So in my example, if you gave the taxidermy collection to, let's say, the YMCA, that is really not tied to their purpose. But if you gave it to the Smithsonian, that is something that they could perhaps display or work in arrangement with another museum. So when you have those types of unique assets, maybe think about charity first. I always encourage folks, talk with your children about what they want. Sometimes it's a hard conversation, but it really makes it easier. Children, I'm going to say, tell your parents if there's something you want, make it easier on them because they really struggle. It's just the parents, if they're asking you, they really want to know. And so it's best to have those conversations rather than, what do you mean Aunt Bertha left me, the 12-foot grizzly bear? So I encourage folks to have those conversations ahead of time.
And, I think the Cabela suggestion wasn't so good because as far as I know, they're not a 501c3.
They may have a Cabela's Foundation, but I am not familiar if they do or they not.
I take
they
it
might
back.
buy it, however. That would be an example of perhaps someone who would be interested in buying that collection.
Well, Stacy and Ashley, I want to thank you for giving us the gift of your wisdom related to giving today. So thank you.
Thanks, Jason.
Thanks, Jason. It's our pleasure. It's always better to give than receive.
Well, hopefully that was helpful to all of you, particularly the part that where Stacy talked about tax certificates. I know for me that was kind of revolutionary. We've got a couple of questions that came in. So Ashley, I'm going to start with you. When you give, how do you know how much to give? You think about it in terms of a percentage, a dollar amount, any tips there on that?
Thanks, Jason. This is really such a fitting question because at Foster Group, our mission is to help our clients lead lives of meaning and generosity, whatever those things may mean to them. And I would say, number one, giving is a very personal choice, and it should be a sustainable choice. Everyone has a unique income situation. Everyone has a unique asset situation. Everyone has a unique tax situation. So for some families, that may be a few smaller gifts. For some, that may be a few larger gifts. I would encourage anybody wondering about the right amount to give to consult with their advisor. If you're a foster group client, certainly we can help you with that because it really is such a personal question. And I would encourage an open conversation about how that looks.
Thanks a lot, Ashley. Stacy, this is kind of somewhat related. But we had a question come in. A person said, they really do enjoy giving to lots of organizations. And their question was, should I give a little to a lot of organizations, or should I give more to fewer organizations?
Thanks, Jason. Again, that's really kind of a personal choice based on, are the organizations important to you? Oftentimes, people do what's kind of called shotgun giving or checkbook giving, where, say maybe Jason comes to your door and says, hey, I'm collecting for the, Leukemia Lymphoma Society. Would you give a donation? And you write a $25 check. And then you walk by the red kettle at the grocery store and the bell ringer, and, so you put some money in the kettle or you stick a check in there. And so you're just sort of spreading your gifting around, and there's absolutely nothing wrong with that. And that's really how most people give. You get a request in the mail, from the food bank. It's that time of year, and you put a check in the mail. So there's absolutely nothing wrong with that. But if you really want to try to have an impact with your giving, or you have the financial ability to have an impact with your giving, I encourage folks to really just kind of sit down and think about their family values and the organizations that are important to them, that are meaningful to them. And once a year, whether it be at the beginning of the calendar year or however you do your giving, kind of sit down and focus on the organizations that you want to give to that year. And it can be a family affair. Include your children. It's a great way to introduce them to giving. Oftentimes families, this really catches on, and We'll have grandparents who will take the grandkids and they perhaps have the means to do it and bring all the grandkids together and talk about giving and say, okay, each grandchild gets to give, $100 to an organization. And everybody's going to talk about it and why you picked the organization you picked. And so it's just a great way to sort of get that giving bug going. But I would say, if you have questions about giving, Ashley or I would be happy to sit down and help you sort of come up with a plan for giving. Think about the organizations that are meaningful to you and important to you, and give whatever is best for you and for your family.
Thanks, Stacy. Well, we're actually at time already, so we got in at least another question too, and we'll make sure to respond to that by email. So just as we wrap up, a few reminders here. First of all, the video has been recorded and you'll receive a link within a couple of days. And we want to say thanks to all of our clients who joined us. Most of all, we're just grateful for the opportunity to partner with you. We also want to say thanks to all of you who are not clients yet. Hopefully the webinar was helpful for you today. We would love the opportunity to get to know you and your situation, see if we could help. So if you want to start a conversation about anything financial, you can use the contact information on the screen to get a hold of us. And finally, a couple of follow-up items. You're going to be sent a link to a survey. We would be very grateful if you took a few minutes to fill that survey out. Your feedback is very important to us. It helps us get better. And also, when you close out of the webinar today, you're going to be directed automatically to a web page that has stories and other information about charitable giving that we hope is helpful too. And I suppose I really want to close with this. My family recently told me that I needed to give up telling Thanksgiving jokes. But I told them that I just am not able to quit cold turkey. Happy Thanksgiving, everyone.
Happy Thanksgiving.
Happy Thanksgiving.